What's going on, everybody? Good morning and welcome back to Beat the Bell, presented by Kane Capital. So the market this week took a little bit of a shit, but that's all right. We're still in good spirits. Hopefully you guys have all had an awesome trading week. We have one more day. Friday is finally here. We do have a special guest on this morning's episode. Before we get to him, let's introduce the veterans, starting with Money Mander. Money Mander, good morning.
Good morning, happy Friday, and a wild trading week. We'll be covering in a second here what the Fed said.
All right, Noah, good morning.
Good morning. Happy Friday, team. Let's get after it.
And our special guest for the day, Jordan, a.k.a. Ace the Kid. Jordan, good morning, man.
Morning. How's it going, guys?
Awesome. Glad to have you here. All right, let's go straight into our Fed forecast and economic calendar. Take it away.
Yes, sir. Let's start with the economic calendar, which we really don't have much today. We have a Fed speaker at 8:50. That's not the economic calendar, but don't worry about it. Fed speaker 8:50, and then flash PMI at 9:45. That's really the only data that we have coming out today. But obviously, this entire week we've been getting data, so let's dive into it. This week has been a busy one with the most notable, obviously, being Wednesday's FOMC meeting. But even before that, the economic data gave reason for concern. Tuesday, Canada had a surprising inflation reading to the upside, a third consecutive monthly increase, bringing the headline number to 4%, up from the lows of 2.8% in June. So this sparked some fears of resurging inflation pressures, once again reinforcing the idea that federal banks everywhere are still a long ways away from taming inflation. Additionally, housing starts came in weak, falling 11.3% month over month. In the month of August. This is the largest 1 month decline in over a year, suggesting that the housing market is continuing to cool down. And all of this was on Tuesday before, obviously, Wednesday we had FOMC. So Wednesday's FOMC meeting resulted in no change to the federal funds rate, a decision that was well telegraphed by Powell and his colleagues since the committee's last meeting in July. It was Powell's relatively hawkish comments in the press conference, however, that helped push markets into a steep decline over the past 2 days. We didn't have Beat the Bell on Wednesday morning, but one of the things I was going to touch on was the importance of the dot plot, right? When you have a very well telegraphed rate decision, right? So it was pretty much a 99% chance that they were not going to hike rates. The focus really shifts to their forward projections, which is the dot plot. So that represents the FOMC participants' views on where interest rates should be at various points in the future. Though no hike was overwhelmingly expected at this meeting, at the end of July, most FOMC participants still believed another hike would be appropriate before the end of the year. Wednesday's data release revealed that is still the case. The committee is torn on whether or not to raise rates by an additional quarter basis point, and whether they do or do not will heavily depend on the data that comes in the next several months. That will better reflect the cumulative sort of effect of Fed tightening over the last year and a half. If you've been anywhere besides under a rock these past couple of months, you've heard the term higher for longer shoved down your throat at this point. But what does that really mean? In June, the FOMC participants were projecting 4 rate cuts next year, right? Implying that they'd get inflation close enough to their target that they could start to ease some of the restrictive policy that they've implemented over the last 18 months. Wednesday's meeting revealed that given current levels of economic activity, most officials expected that they would need to keep interest rates near their current level through next year. So the median projection showed that officials expect to lower the federal funds rate to around 5% by the end of 2024, implying only 2 rate cuts for next year, assuming that they hike one more time this year. So that higher for longer narrative is essentially the Fed pushing back their expectations with respect to how soon and how aggressively they can cut rates. The longer rates stay elevated, obviously, the harder it is on stocks, both directly through higher borrowing costs for businesses and indirectly through valuations of future cash flows. Man, what do you got?
Yeah, so I think that was obviously going to be the big thing. And going back to June, they raised their forward projections for end of year next year and end of year 25 by 50 basis points already. So going back to March, now into the end of 2024 and the end of 2025, you know how a full percentage point higher for projections at the median level there going into the end of both those years. So now they're looking at possibly 2 rate cuts, assuming we get one more here. I think it was a 12-6 split if we, voters wanted 12 or 6 said we're good here, probably no hike. But now going all the way out into the end of 2025, I mean, now you're only looking at a 1.5% projection pulled down over the next 2 years. And so that is like really higher for much longer than anticipated and being priced in. And so I think a lot of this rally that we've seen, the divergence we've talked about between QQQ and TLT and all these things, it may really start to come to matter because the markets were getting very optimistic that the Fed had everything under control. And it's really starting to look like that might not be the case. And we're going to be stuck at these higher levels for longer than they had anticipated even just 6 months ago. And so going into after the meeting here, bonds went completely bidless. We've seen yields through the roof over the last 2 days. And we pull up the chart here. The 2-year note is now trading at the highest level seen since 2006. You have the 10-year at almost a 4.5 handle. And moving forward here, if we go to the next one, Ryan, this is the biggest thing that I want to harp on here. For the majority of the past 20 years, the fundamental correlation between bonds and stocks has actually not been present. So when we had the Fed putting rates at 0 and we had ZIRP for the better part of 2 decades, even if regardless of how bonds moved, that was still very bullish for the stock market. And so you really didn't see that fundamental correlation between yields going higher and stocks coming down. However, you can see right now for the first time really in the past 20 years, we have a very, very strong correlation to that fundamental level on a 1-year change here between treasuries and stocks. And so as we're starting to see yields run through the roof on the higher for longer narrative that the Fed just stamped higher, much higher for much longer, this is really going to put a lot of pressure on the stock market. And so if we take a look at the correlation divergence we've really built since we started getting these projections raised pretty much in March, TLT here and QQQ should really run on a fundamentally similar level because as bonds go down, you would expect stocks to go down. Bond prices coming down is then going to elevate yields. But you can see this big divergence here that we've kind of been harping on for the better part of 6 months, but it really hasn't come to fruition yet. And I think right now is going to be the time that it certainly could as we start to see a lot of risk off coming in the markets as pretty much what was priced in over this entire rally from the start of the year is really starting to seem a little crumbly at its base.
I think when you look at basically what the Fed is projecting for next year, right, where they think that they're going to bring rates, I think that was probably the biggest surprise to come out of Wednesday, right, was where they're looking to or how soon they're looking to cut, because every meeting it seems like it's getting pushed back, right? And investors obviously love to be optimistic and love to look for forward looking, right? We want to down the road we want to see cuts as soon as possible because everybody loves that low interest rate environment where stocks just rip and you have things like Tesla up 1,000%, right? Like everybody wants to get back to that. And it seems like every single time that we have an FOMC meeting, that date gets pushed back further and further and further. And so it'll be interesting to see. Obviously, we've already seen the stock market reaction over the last 2 days with the indices breaking key levels of support and taking out last month's low in the S&P 500 and coming really close to that low in the NASDAQ. We'll have to see if that, like you said, that sort of that correlation between TLT and QQQ that divergence continues to get squashed, or if it's going to continue to grow here over the next couple of months. That'll wrap it up for us here at Fed Forecast. Pass it back to Alejandro.
Thank you. Let's take a quick look at the momentum in the S&P, taking a look at the higher time frames, the 30-minute and 1-hour charts, and using some key moving averages. So we got the bearish cross of the 10 SMA below the 50 SMA. That is the sell signal on the system. And as you guys can see, the 50 SMA has been serving as resistance. I started the show by saying that the market took a shit this week. This was quite the move down. And we haven't seen this big of a drop since before the March low. So this was a significant pullback in the market. Seasonally, it does make sense. September and these 2 weeks in particular are the most bearish weeks of the year. So it really should come as no surprise, despite the velocity of the selling, which is something that we really haven't seen, right, in a long time. Most of the selling that we have gotten has been very orderly and just kind of slow grind down. If we take a look back at the charts, we can see how every pullback we've gotten as of late has just been a slow grind down, but bulls have been able to right the ship. Will that be the case this time? We'll have to wait and see. Okay. Obviously, we're deeply, deeply oversold now. We are getting a pop in the pre-market with the S&P futures up about 20 points. So it is going to be important to monitor where we end the week. But nonetheless, a beautiful trend move yesterday. Hopefully, some of you were able to catch it on the breakdown below the 50 SMA. Okay. So now, of course, for bulls to regain control and for people to have, or traders to have confidence in bulls regaining control, you're going to want to see a reclaim of the 50 SMA on both these charts. That's, of course, just one way to trade it, but a pretty good indication of a potential relief bounce. All right. That's going to do it for the system, guys. Going to go over to Jordan now. Excited to have him on the show this morning. Jordan is a Rocket Scooter affiliate. As you guys know, we love Rocket Scooter. We use Rocket Scooter in our trading every single day. From what I've seen, Jordan is a really good trader who uses Rocket Scooter as well. So he's going to share some stuff with you all this morning. Jordan, happy to have you here. What do you got for us, man?
Let's throw it up there. Let's see. Did I share my screen? Is it working?
Give it one sec. No, it's not working. So if you just hit share screen, select the window, and then we should be able to get you up and rolling. If you need a second or two to get that figured out, we could go over to.
Yeah, I just need a second. It's making me do something real quick.
No worries. All right. Before we go to Jordan, we'll say that for the end of the show, so stick around. We're going to go straight into Bet the Bell, starting with number one question of the day, green or red. I'll start with Noah. Green or red today?
I will. It's tough. We're up like 20 points here in pre-market, as you mentioned. I'm going to go green today. Little relief bounce to end the week. That's what I'm hoping that we get. Green.
All right, Mander.
I'm going to take the exact same thing. I think we need some type of relief bounce here, and Qs are up 0.75% or so in the pre-market, so I'm going to take green.
All right, I'm going to take green as well. Jordan, green or red today in the indices? In SPY.
I'm gonna say green. Sorry, it took me a minute. I'm clicking around, but I'm gonna say green. We've been hitting down the past few days. I know things have been falling hard, but I would say we get a bit of a relief bounce on Friday to end the week. Hopefully, going into Monday, we get a little more as well. But yeah, I think we'll be green today.
Yeah, I'm in agreement there. All right. So lots of greens across the board, something to monitor. Let's go into our second question. Ryan, if you don't mind putting up the tweet. All right. So unusual whales tweet. As of August, monthly trading volume at Binance US has declined 98% from January 2022. Let's get general thoughts here. We've been talking about the crypto markets as of late. Snipes recently asked us the question. I talked about how I feel the crypto markets are sort of the Wild West. I do think it's important to have a little bit of exposure, especially at our age. We're young. If we lose money, who really cares? What are your guys' general thoughts about the crypto market, where it's heading, and how do you think that exchanges like Coinbase and Binance are going to fare moving forward? Starting with Noah.
I care if I lose money. I know I'm young, but I care personally. I think looking at the decline in volume, obviously that's a bit concerning, and really more so, I wouldn't say concerning a ton for like the asset prices, more so concerning for the exchanges themselves, because that's how they make money. So like you said, like the Binances, the Coinbases of the world, like that would be obviously a heavy concern for those companies. But for crypto prices themselves, I mean, like you said, it's sort of one of those things that I just feel like I don't know. I feel like I have to have a bit of exposure to, like, regardless of how you see it panning out in the future, right? Obviously, nobody knows, what the future is going to bring for the likes of Bitcoin, Ethereum. I'm not like a meme coin guy or anything like that, but I think at the same time, like you said, if you have a relatively long investment horizon, it can't hurt to take a flyer on some of the main ones. So I've got a little bit of Bitcoin, got a little bit of Ethereum, and those are sort of like hold it and see what happens kind of trades for me.
All right, Mander.
I'll hop in here. I think this stat's a little skewed here because it was specifically Binance volume, and I know Binance has been at the heart of some SEC investigations, kind of the second part coming out of FTX. There's really just a lot of corruption going on in the market, unfortunately, through these brokers. And so I think that's probably a big one, is that maybe it's not the crypto industry itself, but specifically Binance. But at the same time, I think a lot of investors' confidence is kind of just down in the market right now after the FTX fallout. Now seeing Binance, which I'm pretty sure was probably the third biggest behind FTX and behind Coinbase, seeing these SEC investigations and things starting to come out from under the hood, saying that things were not as advertised, and you're starting to get worried about your money being safe on this exchange, on that exchange. I think it's kind of just taking some of the fun and the safe, what do I want to say? The confidence of investing in crypto is kind of getting sucked out of the market right now. I think a lot of people are fearful to get in because it's so unregulated. And I think that was the draw at the start, is it's unregulated. And so, you have these massive squeezes that we saw. Everyone was so eager to get into these decentralized finance tokens and everything. But I think now that's starting to get to the point where it's not confidence inspiring, so people are not too eager to get back in. I think it bodes well for Coinbase, though, to Diamond's point, because Coinbase, like we've said, is the only publicly traded exchange out there. So they really can't have any corruption. They're publicly audited and they post financial. So of all exchanges that one at least has assets to back what they're saying. And so I think all that going on, once this all blows over, I think it puts Coinbase in a really good position.
To be fair, Binance is actually number one in terms of volume traded globally. So they actually are the largest crypto exchange by actually like a pretty fat margin. I think it's like 9.23. They did 9.23 billion on average daily trading volume in August versus the next one up, Top Credit International, 3.96. So almost a double.
Is that a finance term? Fat margin? Did you learn that
Yes.
in your master's program?
Yes, that's what they teach at Penn State.
University?
That's what they teach at Penn State. Fat margin.
All right, let's go over to our next question. This is obviously going to be for you too. Will the Fed hike again before the end of the year? Thoughts? You already gave thoughts earlier in the show, but let's reiterate the main point here.
So I, believe it or not, I don't think they do. And I think they, you had voting members. It was a 12-6 split, which obviously puts it in the favor of another hike. But I think there's going to be a case where they just kept it where it was at to leave the possibility there. I think it's one of those like taper the market's expectations. And so even if they didn't see a hike coming into the November or the December meeting, if you leave it there at 5.6, you get the reaction we just saw. And so I think that's probably what they want to do, is tame expectations and not let the markets get frothy, kind of calling their bluff. But I'm kind of in the camp, I don't know if we get another one. I think we've probably seen the top of this rate hike cycle.
I don't. It's so tough to say. So the reason that this is even a question, right, is because the Fed, like we talked about in Fed forecast, they're projecting at least one more hike before the end of the year, right? The largest banks, JP Morgan, Goldman Sachs, a bunch of them all believe that the top for rates is in, right? They don't believe that they're going to hike rates again, even though the Fed is more or less saying, the majority of members say that they do believe that they should hike rates one more time. And obviously they always say, that's data dependent. And what they do is, exactly like Mander said, they use that forward expectations little piece of their tool, right? Like that is one thing that you learn at Pennsylvania State University, is they use that forward expectations to help manage the yield curve going forward. And so, like Mander said, if you tell the market there's a chance, that we'll raise heights or raise rates one more time before the end of the year, the market at least will price in that probability and like Mander said, not get ahead of itself, really looking for the top end rates and the eventual cuts to follow. So I think that what they've done is just given themselves a position of like maximum flexibility by saying, we may hike again. It depends on the data, and we'll see. They've put themselves in a situation where they can go either way and it wouldn't, wildly surprise markets. So I'm going to go with they do hike again. That's what I'm going to go with. Fed doesn't lie, bro. Like they that's what they've said. They've been pretty spot on this whole time. They say they should raise rates again, maybe. So I'm going to go with yes.
All right, there you have it. The last question now. If you were put in this situation where for the next year you could only trade the first 45 minutes of the cash session, aka 9:30 a.m. to 10:15 a.m. Eastern time, or the last 2 hours of the day, 2 p.m. to 4 p.m. Eastern, which time slot would you choose and why? We'll start with Jordan.
I would 100% trade the first 45 minutes. I know there's a lot of volatility at the end of the day, and I see a bunch of people making lots of money, but I don't know. For me, it's like in the morning, I can start out and, hey, take a trade on the volatility, and if it doesn't work out, I have all day to kind of, relieve myself of that loss. Whereas, like, at the end of the day, if it doesn't work out, it's over with right there, and you got to end your day. So that's what I don't like about it, but there's definitely some good moves at the end of the day, but I'd have to pick the first 45 minutes.
All right, Noah.
I'm going to go with the first 45 minutes as well. I think the last 2 hours of the day is a little bit, I don't want to say easier because like trading is never easy, but like comparatively to the first 45 minutes, I think the moves just like they develop slower, which is why I think it's quote unquote easier. But like if I had to choose one, I think I would take the first 45 just because the volatility is almost guaranteed. Whereas like at the end of the day, you don't really know if you're going to get volatility. And the market could sort of just chop around and chop you out of a position. So I'm going to go with the open.
All right. And Mander.
I'm going to take the exact same position because I think 2 to 4 is too hit or miss for me to commit to only trading it. I think when there's trend days and you get that lunchtime pullback or, either or, and then you continue the morning session trend into the close, then the 2 to 4 window is honestly a great window to trade. But it's too hit or miss because then you'll also have days where you just chop and dealers are closing out positions into the bell and you get nothing in the afternoon session. But every single day there is always volatility in that first 45. And so I'm going to take that.
I should have made it harder. I should have made it like 9:30 to 9:45 or like 9:30 to 10. Maybe that would have but
like you got to snipe right out of the bell.
Yeah. I'm also picking the first 45. This is kind of a no-brainer. Noah, you mentioned something that's interesting. You said that the moves happen slower in the afternoon, which is easier because it's moving in like slow motion, I guess. But for me, that's actually more difficult because that's like I'm in a position for a longer period of time. Maybe I'm getting chopped up. Like that's just like the reason I like trading the open so much is because like I can get follow through in a trade in 15, 20, 30 minutes. Like that's what makes trading the open like so beautiful. And then you can just shut it down for the rest of the day. But the most important point that was made, I forget who said it, was like there's no guarantee of volatility in the afternoon, obviously, but in the morning, like those first 15 to 30 minutes, there's always a trade to be had, always. And so, you can find that one trade, but in the afternoon, I don't know, it gets way more difficult. All right, so very quickly before we let Jordan go here, I know that he has to dip out. Jordan, some thoughts that you have coming into today. Unfortunately, we had technical difficulties as well, so we weren't able to do screen share, but we will be having him on once again shortly. But coming into today, what are your thoughts? How are you using Rocket Scooter? What's your game plan?
Yes, sir. So it's been a tough few weeks for sure, but using Rocket Scooter, I've been able to nail some plays, and I've been basically just scalping back and forth, very, very small, honestly, not doing anything too crazy, but what I'm looking for this morning is you can see we're bouncing pretty good in the pre-market. We haven't really seen a bounce like this the past few days in the pre-market, so definitely a sign of some bulls coming into play. I'm looking at this 200 EMA on the 5-minute. We're coming up to this. That could be some big resistance, but the biggest thing for me is seeing where that hedge pressure is right when market opens, right? So when that comes out, if we open up under hedge pressure, I'm immediately going to start looking short just because, we're under hedge pressure. If we open in a bear zone, that's definitely going to add to that for sure. Whether we open up in a bear or a bull zone, that really adds to my bias as well. But I would expect we open up above hedge pressure this morning. So I'll probably be taking longs on any dips down to hedge pressure, wherever that may be this morning. We don't find out until the market opens. But yeah, that's what I'm looking for the most part. Definitely feeling bullish. If we could get a retest of maybe that 435 area close to yesterday's high, I think that'd be awesome. But yeah, that's pretty much what I'm looking for.
Yeah, man, awesome stuff. And people listening to the show, watching the show, who are in our Discord are definitely familiar with hedge pressure. You guys know exactly what he's talking about. And yeah, it's pretty interesting that you can have your game plan, but using Rocket Scooter, if you're using those levels, if you're using the bull bear zones, you really don't know what you're doing until the market opens, which is kind of the beauty of it, right? It's reactionary. You're not making predictions. You can have your game plan, but
Morning.
at the end of the day, it's what
How we doing, guys?
All right, guys, that's going to do it for this morning's show. Appreciate everybody who tuned in. Appreciate Jordan for joining us. Hopefully you guys were able to get some value out of this episode. Unfortunately, we did have those technical difficulties to where he was not able to share his screen, but that's all right. We'll have him on hopefully next week or sometime in the near future, and he can give a deeper look into exactly what it is that he's doing using Rocket Scooter. All right. Diamond Mander, good stuff. We'll be trading live all day in the King Capital Discord. You guys can go to king-capital.com or scan the QR that is currently on the screen. Have a great rest of your day, everybody. It is Friday. Trade smart. Don't lose your ass. And we will see you back here on Monday morning at 8:30 a.m. Eastern Time. Have a phenomenal weekend, everybody. Take care.